It is certainly a tense time with the ongoing situation between Iran and Israel when we consider the possibility of the US getting more deeply involved, escalating it to a full-blown war. It brings up a lot of questions about what that could mean for Singapore. The ripples of such a conflict could extend far beyond the immediate region, touching everything from the price of your daily meal to the long-term value of your HDB flat. First off, let's talk about the big picture. Singapore is a highly trade-dependent nation, and any major conflict, especially one in a critical oil-producing region such as the Middle East, is bound to have ripple effects that resonate across its economic fabric. The most immediate and often discussed concern is usually oil prices. If the conflict escalates and vital shipping lanes get disrupted or threatened, you can bet oil prices will skyrocket. For a country like Singapore that imports pretty much all its energy, higher oil prices mean significantly higher costs across the board. Think about it. Transportation becomes more expensive, impacting everything from logistics for businesses to the cost of getting your groceries. Manufacturing costs climb as well since factories rely heavily on energy. This cascade typically translates directly into higher inflation, meaning the purchasing power of your Singapore dollar diminishes and your daily expenses for everything from food to electricity bills can go up. We have seen this play out in various forms during past oil shocks, like in the 70s or in the early 2000s, where global events caused significant pressure in even a stable economy like Singapore. Now, how does this affect our housing market here in Singapore? It's a fair question, and history can give us some interesting clues, although of course, there are no two crises that are identical. If we look back at the Iraq War in 2003, or even earlier periods such as the Asian financial crisis in 1997 to 1998, or even the global financial crisis back in 2008 and 2009, the direct and immediate impact on Singapore's property market wasn't always as severely negative as one might expect. In fact, some analysis even suggest that during times of external shocks like wars or geopolitical instability, the Singapore property market, particularly residential real estate, tends to be remarkably resilient and can even be seen as a safe haven asset. People, both local and international, might pull money out of volatile and uncertain stock markets and instead choose to park it in tangible assets such as property, especially in jurisdictions perceived as stable and secure. We even saw transaction volumes increase after the start of some past conflicts, indicating continued buyer interest as capital sought refuge. This is because Singapore, with its stable political environment, transparent legal system, and strong economic fundamentals, is often perceived as a safe and a reliable place to invest capital when other parts of the world are in turmoil. I believe the key difference this time around is because now Singapore has that 60% ABSD for foreigners, which might influence foreigners to buy property in other countries instead. So we are not entirely immune. Rising construction costs due to higher energy and material prices is a direct consequence of a prolonged conflict and disrupted supply chains. This could eventually feed into higher home prices. This impact might be more muted and gradual compared to the immediate pressures on other goods and services, but it is still a factor. If prolonged, global instability could lead to a significant slowdown in economic growth and job losses that could eventually put downward pressure on demand and affordability. Yet, Singapore's robust domestic demand, particularly for HDB and mass market private housing, tends to provide a strong base of support. What about interest rates? Well, this is where things get a little bit more complicated and could directly influence mortgage repayments. Typically, during wartime, especially if it leads to higher inflation, central banks around the world, including MAS in Singapore, might be pressured to raise interest rates. This is a common monetary policy tool used to try and cool down an overheating economy and manage price hikes. During past major wars, like World War II for example, governments sometimes even tried to keep interest rates artificially low to make war financing cheaper. However, that often came with significant and sustained inflationary pressures that could destabilize an economy in the long run. If the US escalates its involvement and global inflation becomes a serious and persistent concern due to supply chain disruptions and surging energy costs, it's quite likely that we'll see interest rates go up further or at least stay elevated for a longer period than currently anticipated. This would mean that borrowing money, particularly for significant assets such as a home loan, becomes more expensive, increasing monthly mortgage repayments for those with floating rate loans or those looking to buy. This in turn could dampen buyer sentiment in the property market over time, making it less attractive for some to purchase homes and potentially leading to a moderation in price growth, even if the safe haven effect persists for high net worth individuals. The MAS would have to balance inflation control with supporting economic growth, a delicate act in uncertain times. Beyond oil prices and interest rates, a full-blown war could severely disrupt global supply chains in a multitude of ways, making it harder and more expensive to get goods. Singapore, being a global logistics and trade hub, would certainly feel that pinch acutely. Our port, which handles a massive volume of cargo, could experience delays and increased costs due to rerouting or heightened security. Furthermore, our exports could take a significant hit if major trading partners in Europe, the US, or other parts of Asia are grappling with their own severe economic challenges stemming from the conflict, leading to reduced demand for Singaporean goods and services. Reduced global demand would inevitably impact Singapore's export-oriented industries, from electronics to chemicals. The financial sector, another pillar of Singapore's economy, would also face increased volatility and uncertainty, potentially impacting investment flows, capital markets, and overall economic growth. Businesses might become more cautious, delaying expansion plans or investments, and consumer confidence could waver, leading to a tightening of belts across the economy. The good news is that Singapore has a pretty robust and adaptable economy forged through decades of navigating global uncertainties. We have built strong financial reserves, meticulously diversified our supply chain, and strategically broadened our trading partners over the years, specifically to weather such storms. Our government is also known for being very proactive in implementing various policies to ensure financial stability and support businesses and households during tough times, such as demonstrated during past crises such as SARS or the COVID-19 pandemic. We have a track record of implementing stimulus packages, supporting employment through schemes like the job support schemes, and providing targeted relief when needed. We also maintain a strong focus on human capital development through initiatives like Skill Future, ensuring our workforce remains adaptable and resilient. However, of course, there is no denying that a major escalation in the Middle East, especially with significant US involvement, would present profound and complex headwinds. It is a delicate balancing act requiring careful economic stewardship, constant monitoring of evolving geopolitical landscape, and a readiness to respond with agility to safeguard Singapore's economic stability and the well-being of its people. The resilience built into our system will be tested, but it is precisely for moments like this that Singapore has meticulously prepared. So what can regular Singaporeans do in such time? Firstly, it is always wise to bolster your personal financial resilience. This means having a healthy emergency fund, ideally 6 to 12 months worth of living expenses, and it should be in accessible saving funds. This cash buffer can provide a crucial safety net if job security becomes a concern or unexpected expenses arise due to inflation. Secondly, reviewing your budget and cutting back on non-essential spending can free up more cash for savings or to offset rising costs. It's also about time to be mindful of your expenditures and distinguish between needs and wants. Thirdly, for those with investment, a period of uncertainty often calls for a review of your portfolio. Diversification is key. Don't put all your eggs in one basket. While certainly sectors such as defense or energy might see a boost during conflicts, broad market indices generally offer a more balanced approach. Some investors might consider assets traditionally seen as safe havens, such as gold, but it is important to do your research and perhaps consult a financial advisor to ensure your investment strategy aligns with your risk tolerance and long-term goals. For those with home loans, understanding your interest rate structure, whether it's fixed or floating, and considering ways to manage potential increases like refinancing or making partial prepayments if feasible could be prudent. Finally, staying informed through reliable news sources is important, but equally crucial is avoiding panic and knee-jerk reactions based on sensational headlines. Singaporeans have always shown a pragmatic and adaptable spirit in the face of challenges, and applying that same resilience to personal finance will be very valuable. Don't forget to like and subscribe, and I'll see you in my next video. Bye bye.